Today, we will talk about understanding liquidity and how to measure it. Liquidity is the ease of converting an asset or security into cash, with cash itself being the most liquid asset of all. Liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. The most liquid asset is cash. The more liquid an asset is, the easier and more efficient it is to turn it back into cash. Less liquid assets take more time and may have a higher cost. Liquidity describes the degree to which an asset can be quickly bought or sold at a price reflecting its intrinsic value. Cash is the most liquid asset, while tangible assets like real estate or collectibles are relatively illiquid. Market liquidity refers to the extent to which a market, such as a stock market or real estate market, allows assets to be bought and sold at stable, transparent prices. Accounting liquidity measures the ease with which an individual or company can meet their financial obligations with the liquid assets available to them. It is important to assess liquidity in order to remain solvent and avoid a liquidity crisis. Financial analysts use several ratios to measure liquidity, such as the current ratio, quick ratio, and cash ratio. These ratios compare liquid assets to financial obligations that come due within a year. Generally, a ratio greater than 1 is desirable, indicating the ability to cover short-term debts. In investments, equities are among the most liquid assets, but not all equities are equally liquid. Stocks with higher daily transaction volumes are more liquid and attract greater interest. Market liquidity is crucial for the ease of trading assets without affecting their price. If markets are not liquid, it becomes difficult to sell or convert assets or securities into cash. Liquidity is important because it allows assets to be easily converted into cash without affecting their market price. If markets are illiquid, it can be difficult to sell or convert assets, leading to potential losses. Having liquidity is important for individuals and firms to pay off their short-term debts and obligations and avoid a liquidity crisis. Here are 4 key takeaways. 1. Liquidity refers to the ease with which an asset, or security, can be converted into ready cash without affecting its market price. 2. Cash is the most liquid of assets, while tangible items are less liquid. 3. The 2 main types of liquidity are market liquidity and accounting liquidity. 4. Current, quick, and cash ratios are most commonly used to measure liquidity. Hope this would help. Thanks for watching.